What's up everyone, my name's Robbie, this is Robbie and Manila, and today we're talking about Johnson & Johnson stock and whether I think it's a buy. So if you've been watching me recently, you know that I created a stock ranking system. My working title for the system is the RIM rank, aka the Robbie and Manila rank, so RIM rank. So that's what I'm going with right now. I might change the title in a while, the branding, I don't know. Hey, if you have any ideas, let me know what you think. Do you like RIM rank? But that's what I'm going with. So basically, the RIM rank is going to be consistent of the following things that we're going to go over. So first we have something called the Rolex score, which is what I use to score both the quality of a company and if I trust the company. Next, we're going through an industry-based valuation. After that, we're doing a profitability-based valuation. Then we're taking a look at the industry-based growth, and finally, we're taking a look at the liquidity score. Now, once we go through all this, we get our RIM rank, then we're gonna go and we're gonna do a discounted cash flow to see if the price of the stock is actually good, and we're finally gonna go through technical analysis on the stock. But I do remember now, I forgot this, I created a dividend aspect to the RIM rank. So we're actually gonna use that today as well, which I have not showed before. So anyway, let's go ahead, let's get into this video and see if this is a good company to buy. All right, so quickly, description below. Let me know, what do you think? You like Johnson & Johnson? You thinking of buying it? Do you currently hold it? Let me know, I'd love to hear from you. And without further ado, let's go ahead and jump into the spreadsheet. Actually, sorry, not spreadsheet yet. We gotta go over what the company does. Quick description, I'm just gonna read this real quick. So, Johnson & Johnson researches and develops, manufactures, and sells a range of products in the healthcare field worldwide. It operates 3 segments: consumer health, pharmaceutical, and medical devices. The consumer health segment offers baby care products under the Johnson's and Aveeno baby brands, oral care products like Listerine brand, which I use on a daily basis, skin health beauty products under Aveeno Clean and Clear, Neutrogena, all sorts of different things. They also have a little something called Tylenol, which you might have heard of. They also have allergy products, Sudafed. It goes on and on. By the way, Band-Aid. So there's a lot of different products you've heard of that this company makes. It's been around for a long time. So if you've never heard of Johnson & Johnson, you've likely at least seen their products before. Okay, now we're actually inside the spreadsheet. So the first thing we're going over is what is the industry that this company falls under, because that's very important in the spreadsheet that I do, because it's an industry-based valuation for a lot of these things. So it's drugs and pharmaceuticals. It's in the healthcare sector, but the industry is drugs/pharma. So the first thing I want to look at when I'm looking at these stocks is I want to see what the Piotroski F score is. So I'm going to go over to Google, not Google, Guru Focus. I'm going to look up the Piotroski F score for Johnson & Johnson. And so here I have Johnson & Johnson up. It actually has a 6. Now, if you've watched my videos before, you know I like a Piotroski F score of 7, 8, or 9. So a 6, while not terrible, does get a bit of a subtraction of points. If it was a 7, 8, or 9, it would get a 5-point score, but because it's under, it's going to get 2 points. So we're putting a 2 here for the score for Piotroski. Quickly, let's see what they got some reductions on. So one of the things that they did not get a plus for was a higher return on assets year over year. So the return on assets declined. So that was actually a deduction. They didn't have a higher current ratio year over year. And then they actually had more shares outstanding, which is also a big no-no for me. And as you'll see in my next part here, I actually bring out shares outstanding because to me it's very important to see how much you trust a company if they're diluting you. Because I don't really trust a company that's diluting me unless I think that what they're doing is justified, which usually it's not, but once in a while it is. So, for example, so this is actually increasing, which as you can see, increasing gets actually a 0. I do not like that, so boom. So what I want to do right now is just see how bad this is. So let's go back and see how much they're diluting us by. I'm just going to paste it inside the revenue growth real quick just to do it. And it looks like they're diluting you by an average over 5 years of 0.41%. So honestly, share dilution isn't very bad for this company. It is there. It could potentially have a very small effect on your rate of return, but actually I'm going to change this because I don't think that that is justifiable to really hurt this company in the ranking for that. So I'm going to instead put this at a 5 and give them proper points because the dilution isn't bad enough for them to be dinged, I guess, for how much they've been diluting you. It's really not that bad. Next thing we have is the industry-based valuation. So down here we see that the PE ratio is 21.47, and what we want is an industry-based average to be no more than 20% of this. So now I'm going to find the industry-based average, and actually the industry-based average is 77.97. So Johnson & Johnson is very much under the industry average, so that's good for them. 77.97. I then want to see the forward PE, so that's 24.29. That's for the industry. And then so let's take a look down here, 24.29. And so with a forward PE of 15.27, that's actually good. So we get 5 points here because the PE is less than the industry average, and then another 5 because the forward PE is less than the industry average. Let's take a look at the price to sales. Price to sales is 4.76. How's the industry? The industry is 4.75. So 4.75, this actually passes the test. It's right with the industry, definitely fine. We get 5 points there. Next we have the enterprise value to EBIT. So Johnson & Johnson's EV to EBIT is 19.29. Let's take a look at the industry's EV to EBIT. So the EV to EBIT is 20.68 for the industry. So we have an EV to EBIT that's actually under the industry, so that's good too. So far we got a good valuation score for Johnson & Johnson. Next we have the industry-based profitability. So we're going to take a look at gross margin and net profit margin. So the gross margin of Johnson & Johnson is 68.20. Let's take a look at the industry. So the industry is 67.35. It's no less than 20% of the average of the industry, so we get 5 points. Next we have the net margin, which is 11.03%. So come over here, 11.03%. Johnson & Johnson has a much better net margin than the industry. 5 points for sure there. Next we have industry-based growth. We're doing this based on a 5-year compound annual growth rate. So first off, we need to go find the revenues of Johnson & Johnson. Let's go over to quickfs.net. We have the revenue right here. I'm going to just copy and paste this into my calculations. So we have a 5-year growth rate of 2.83 is the growth rate. So 2.83 is the growth rate in revenue. Let's take a look at this versus the industry. So the industry has a growth rate of 42.85. So 42.85 goes here. By the way, I accidentally put the actual, I had to switch these up in case you noticed that. But so very behind the average, so that's not good. So this is actually a score of 0. Next thing we want to see is the 5-year average growth rate of net income. So for Johnson & Johnson, net income is right here. We're going to copy this. I'm going to paste it into my calculations spreadsheet. We have 6.42% net income growth. 6.42%. Let's find the industry average for net income growth over 5 years, and this is 20.71. Next, we have free cash flow growth. Let's take a look at free cash flow for Johnson & Johnson. Here I have free cash flow. I'm going to copy this. I'm going to paste it into the spreadsheet. So here we have free cash flow per share growth of 3.28%. 3.28%. So for net income, we are way under the industry average. We're not getting any points there. And actually for free cash flow, we're also not getting any points because free cash flow growth is not that good. Johnson & Johnson is not a growth type company, obviously. It's a dividend paying company, more of probably a value company. So we're going to take a look at the dividend in a few minutes. But for now, the growth score of this is a 0%. Finally, we have liquidity. So we need to find the debt to equity ratio, which is right here, 0.48. That's good. So debt to equity, 0.48. That is a 5 out of 5. So let's go over what we got. We have a Rolex score, quality and trust of 70%. We have a peer valuation score of 100%. peer profitability score of 100%. We have a peer growth score of 0%. We have a liquidity score of a 100%. And finally, our total RIM rank, a total score of 42 out of a total possible 60, putting this at 70%. Now, if you've watched my videos, I might have even mentioned it earlier, 70% is the number that I don't want to go under. So this is exactly what I don't want to go under. So technically, Johnson & Johnson is going to fit into my okay to potentially buy bucket. So next we have to take a look at the free cash flow based discounted cash flow. Sorry, joke. Okay, I forgot. This is a good dividend paying company. We have to go over to my now new dividend scoring system that I have. So let's go over there and let's take a look at the dividends of Johnson & Johnson. So what we have here is, first off, dividend metrics. So we have a dividend increase history of 60 years, an amazing dividend company. If you're into dividend investing, this company has a lot of trust behind it in that aspect. The dividend yield is 2.53%. It's okay, not too bad. It's probably not out of the area where it's going to be concerning to how high the dividend yield is. The growth of the dividend has been 3.74%, which is totally fine. I don't think it's out of the ordinary. It's not too high, not too low either. There's a free cash flow payout ratio. So basically what this is how much free cash flow does the company earn and what percentage of that free cash flow is paid out in a dividend. So 51.91%. 51.91% is totally fine. So next thing I'm doing is actually what's called a dividend discount model. It's a valuation strategy. It's going to help me find a potential target price for Johnson & Johnson. So the first thing I'm doing is using CAPM, the capital asset pricing model. I'm using the 10-year treasury of 1.98%. The beta of Johnson & Johnson is 0.7%. This is all publicly findable info, so easy to find. The expected return is 9% for me. That's what I want to earn on buying this stock. CAPM is going to equal 6.89%. If you don't know how to figure out CAPM, you can Google how to calculate it. Don't need to go through that here. But this is basically going to be used in this dividend discount model. So the annual dividend for next year is 3.98. I got that by multiplying the growth by the current dividend. So the annual dividend, the most recent annual dividend, was 3.98. The growth rate was 3.74%, with the next year's dividend forecasted 4.13%, which is this times this. So basically what you do is, this is a calculation. It ends up using these different pieces of data, CAPM, and this information to find a fair value for the stock. So the fair value for Johnson & Johnson, given all these inputs here, using the dividend discount model, 130.97. The current price is 167, so it's overvalued 21.91%. So according to the dividend discount model, this is not a buy, but let's go ahead and take a look next at some free cash flow, discounted cash flow. So I'm using the free cash flow DCF on Guru Focus to find another alternative way to find the price of a stock. This way, honestly, probably better than the dividend discount model, but to each his own. First question is, what's our free cash flow? It's 5.776 per share, as you can see right here, which is the trailing 12 months free cash flow. So like I used in the dividend discount model, I have a 9% rate of return. I mean, of course, I would prefer to have a higher rate of return, but this is Johnson & Johnson. I would not buy this expecting huge returns. So 9% though is not something I want to go under. Now, as we know, growth is a bit of a problem for Johnson & Johnson. Here we have Guru Focus showing the free cash flow growth over the past 10 years is only 5.90. So this is going to be a problem because, as we can see already, having 5.90 as the growth rate in this discounted cash flow, the fair value of Johnson & Johnson is only $83.19. It's currently selling for $167. So how could we get to the point where I would be comfortable buying this stock? So there's two things I'll do. So first off, let's increase the growth rate. How much does Johnson & Johnson need to grow per year over the next 10 years for me to be comfortable? So the growth rate of Johnson & Johnson would have to be 20.3% annually for me to be comfortable with the price that's currently selling at, because I also want a 25% margin of safety when I buy a stock. So okay, Johnson & Johnson is going to be out of the picture on that one because obviously it's not going to grow at 20.3% over 10 years, although over the past year it did grow at 22.60%. So what's another thing we could do? Well, I could say I'm okay with having less of a return, which I don't want to do, but we could do that for just the sake of understanding this. So if we decrease the growth rate, but then we decrease the discount rate, suddenly it's getting a little closer. So let's say I'm okay with the 7% return. Now we're at 17.3% growth over that time period. Now the final way to think about this is, what if you're not looking for a margin of safety? You're just okay with fair value. Well, then maybe you're talking. So let's go back, put this up to 9 again, but what growth rate are you okay with it being about fair value? And we're talking about probably 16% growth rate over the next 10 years. So 16% growth rate to get to this price today to be fair valued. Personally, don't think it's going to happen. So I would wait for the stock to lose more value, come back down into an area where I would be more comfortable purchasing. What would my personal price target be on this stock? Well, it'd probably be around $90 per share. So we're talking about almost double what it currently is right now. So definitely would think Johnson & Johnson would need to come down for me to buy it. Let's take a look at the technicals. So from November of 2020 until about September of 2021, we had a strong uptrend channel for Johnson & Johnson. It broke down through the channel around mid-September of 2021. Now it's hit some support multiple times, 1, 2, not quite 3 times. So that is definitely a good support level for the stock. $156. It's currently trading around 168, as you can see. Let's draw a Darvis box here. And so this is basically the consolidating area where I see this stock right now. Let's zoom in a bit more. And what I don't like seeing here right now is I don't love MACD. It looks like the oscillator is starting to build. That's when you see these oscillators kind of building. So we got a little red here. That thing could grow potentially. This could come back down. Retest this area. 156 is my thought. I'd watch there. Potential bounce. Now, as you know, you might think I'm crazy, but my buy price for this stock is all the way down here. So that's the way I'm looking at this. So of course, I think Johnson & Johnson, to me, it's overpriced. I'm not buying the stock. I think it does have some good characteristics, but at the end of the day, I don't like the price it's selling for according to the discounted cash flow. So anyway, that's all I have for this video. Thanks so much for watching. Hey, hit that like button if you liked it. Subscribe to see future content like this, and watch another of my videos. It's coming up in 3, 2, 1.